Hello students, this is Professor Faiz Raut from Jain College of Engineering, Department of MBA. I'm teaching subject Legal and Business Environment. I'm in the final module, Module 6. In this module, I'm going to discuss regarding economic policies, fiscal policies, monetary policies, and India's foreign trade policies. Okay, so these three policies, fiscal policy, monetary policy, and trade policy, are very important. Foreign trade policy are quite important for the economy as a whole. Okay, so this is purely about macroeconomics, which we are going to discuss here. Okay, so first, and this all the three policies in turn form an economic policy of a country. Okay, before I begin, fiscal policy, if you remember, fiscal policy is being, these policies are being made by the government. Okay, fiscal policy is the policy which involves the revenue generation and the expenditure on the country, in the country, by the government. So these policies are made by the government of India or government of any state. Okay, and next is monetary policy. Monetary policy is the policy which is made by the central bank. In the case of India, it is made by the Reserve Bank of India. And monetary policy deals with the money management in and out of the country and within the country as well. Okay. Next is foreign trade policy. Okay, foreign trade policy is deals with the import and the export duties, the trade deficits, the trade surpluses, then the current account deficit, what is the flow of FDI in the country, what is the flow of FII in the country, what is the flow from India to any other country. All those trade policies are being discussed in this. So together all these three form the economic policy of any country. Okay, so let's begin with the first one, which is fiscal policy. Okay, fiscal policy, the term is related to the public treasury. As I've told you, the fiscal policy is being made by the government. The term fiscal policy is related to the public treasury. That is how government raises its revenue and how it spends the treasury funds. Okay, so the policy can be defined in more general terms, like the revenue which the government gets. Okay, the main generation of revenue for the government is taxation. Okay, or borrowings from any from the market or from the central bank. So all these things consist of the revenue for the government. So this revenue is being collected or taken in order for the economic growth of the country. Okay, so there are basic objectives of fiscal policies. Okay, and these are the four main objectives of fiscal policy: economic growth, promotion of employment, economic stability, and economic justice or equity. Okay. So the main motive of any government of any country is for the growth of the economy. So government can make certain fiscal policies or certain policy changes in which they'll support agricultural activities, they'll support the services sector of country, they'll support the manufacturing, they support the trading activities in the country, they are supporting the small businesses, large businesses, medium scale businesses, micro scale businesses, and in turn pushing the economy toward upside, so that the economic growth of the country happens. Okay, second is promotion of employment. Okay, unemployment is the very worrying factor for any worrying macroeconomic factor for any country. Generally, in any of the economy as of today, unemployment nearly 5% is not so bad. Okay, so 5% unemployment is always there in a country. If you want everyone 100% to be employed in any of the country, it is next to impossible. So there will be unemployment problem in any of the developed economy as well. So, but we need to reduce it. We need to take care that the unemployment doesn't crosses 10%, 15%, 20%, 25%. So that if unemployment is more in the country, the development of the country will get hampered. Okay, so the government creates the employment opportunity using these revenue which has been generated by the taxes. The government creates these employment opportunities. So, for example, Mahatma Gandhi National Rural Employment Guarantee Scheme is there, which is MG Narega. which we call. So government creates or some of the activities like building of roads, building of dams, so they can employ people who are unemployed, so that the employment generation happens. They'll earn money, and they can use the money on any of the capital or their day-to-day activities, so that the economy works. So that the government doesn't like to give money to its population free of cost, so that the population should not become lazy and lethargic. So the promotion of employment is also important, and it takes place through this fiscal policy. Third is economic stability. Okay, the economy should not go up suddenly and then drop suddenly, so that the up and down cycle of economy should not be very drastic. There should not be too much fluctuations. So there should be a flattening of curve, not very high, not very low. So to achieve this flattening of curve, government keeps on changing its fiscal policy. If economy is going very high, then government can increase the taxes, so that the economy can be pulled down a little bit. If the economy is going down, then government can reduce the taxes, pump money into the economy, and can help to flatten the curve. This can be done by changing the fiscal policies. Last is economic justice or equity. Okay, so as I've told you in the previous classes, the gap between rich and poor is very detrimental for any economy. So the gap should be reduced, and as of few months or last year's data, the 10% of rich in India, the 10% of the people in India holds more than 50% of the wealth of the country, and rest 90% hold less than 50% of the wealth of the country. So there is a huge gap between rich and poor. So that economic justice or economic equity has been achieved through fiscal policies. Okay, so these are some of the objectives which the government takes in the fiscal policies. Okay, next is regarding fiscal instruments. Okay, how this fiscal policy is being implemented, or how this fiscal policy is being formed. What are the things which has been changed? So these are the instruments. Okay, so using these instruments, the policies are changed by the government. Okay, first is a budgetary policy. Okay, budgetary policy, as I've told you, budgetary policy is being included under fiscal policy. So budgetary policy refers to the government's plan to keep budgetary policy refers to the government's plan to how they will be spending the revenue which is being generated over a period of time through direct taxation, through indirect taxation, or through any borrowings. How they are going to spend this revenue, money which they have received through taxations on the public, on the public, basically. Okay, and this budget, this budgetary policy can be three categories are there in this. Okay, this budget can be a balanced budget. This budget can be a surplus, or it can be a deficit budget. Okay, balanced budget, by that I mean the revenue which has been collected over a period of time, over a period of 1 year, is been exactly used for the spending or the expenditure by the government. Okay, if 1 lakh crore is been collected through the taxes as a part of revenue, then 1 lakh is being spent for the public as an expenditure, then that is a balanced budget. So 1 lakh we are receiving, 1 lakh we are spending. Surplus budget is we are receiving 1,50,000 crores as a part of revenue, and we are spending only 1 lakh. So 50,000 crores is our surplus with the government, and deficit is we are receiving 50,000 and we are making a budget of 1 lakh. So that is a deficit budget. So generally, if the government wants the economy to boost up, the government is many a times in the deficit budget. So many of the things in budget find it very difficult to implement. So this is about the budgetary policy. Depending upon the budgetary policy, the fiscal policy keeps on changing. And next is government expenditure. Okay, government expenditure includes the total public spending on the purchase of goods and services, payment of wages and salaries to the public servants, public investments, infrastructure development, any construction of any dams, roads, railway lines, all those developments, and any transfer payments, for example, pensions, subsidies, which the government provides, then unemployment allowances. If you go to employment exchange, you get some amount as you are unemployed, and any grants or any aid is being provided, any payment of interest or amortization of loans, all those expenditure done by the government is included in the government expenditure. Okay, and next is about taxation. Okay, taxation is the most important thing, most important revenue generation item for the government. Government relies on tax for any public funding or any public expenditure. So tax is a payment by the people to the government. Okay, there are two types of tax. Okay, direct tax and indirect tax. Indirect tax we call the main thing of indirect tax is now called as GST, goods and services tax. Direct tax is being paid by the person who falls under the tax bracket and the different type of percentages on his income. Directly on his income, whatever he is earning, he is directly paying the tax amount which is applicable to his income to the government. So that is a direct tax. Indirect tax is we are buying something, okay, or using some services, so on that we are paying some amount as a indirect tax. So that after we are consuming something or buying something, that tax is being collected by the government, not on our income. So that is indirect tax. So just a brief definition. So by this direct tax and indirect tax, government receives the revenue. Okay, next is public borrowings. Now, if suppose the taxation amount is not fulfilling the need of the government, which the government wants to do for the public spending, the government can make borrowings, and there are two types of borrowings: internal borrowings and external borrowings. Okay, internal borrowings are the borrowings from the public, by means government bonds or treasury bills is being floated in the economy. Now, I'll just give one example. Government bonds or treasury bills, I have just told you. Treasury bills or T-bills, they are referred to as. Those are the bills which is been sold to the public, and for certain short period of time. Okay. The short period of time, by I mean it can be a 91-day treasury bill, 180-day treasury bill, 6-month treasury bill, as maximum goes up to 1 year. So within 1 year, the government floats the bills. Okay, public buys those bills, and after the maturity, the government takes back the treasury bill and pay the amount plus some interest amount to the seller of the treasury bills. So by this, the seller gets an advantage. He gets an interest payment, and government gets money for the short period of time which they required. So by this, by floating treasury bills or by floating government bonds, government can collect money for a certain short period of time if they are short of money revenue, and they want to do some public expenditure. Okay, second is a borrowing from the central bank. Okay, the money which is been collected by the central bank or kept by the central bank is not basically a government money. Okay, government doesn't own the money which is held by the central bank. It is central bank's money. So when government is taking money from central bank, in this case, in our case RBI, when government is taking money from RBI, it is borrowing the money from RBI. Okay, so there are two basic, this you need to understand, there are two basic policies which I have mentioned: monetary policy and fiscal policy. Okay, the policy, both are money related to money, but the money which has been within the government control, with that money they can make fiscal policies. So money which has been with the central bank or RBI, the policy which they make is of monetary policy. So there are distinction between money which the government holds and the money which the central bank or RBI holds. Okay, so when the government is borrowing something which is internally from the country itself, then it is an internal borrowing. And external borrowing is from the foreign governments, okay, from the IMF, International Monetary Fund, from the World Bank. If country is going to borrow money from foreign governments, from international monetary funds, or from World Bank, or from any foreign market, okay, any foreign banks, okay, in that case it is external borrowings, and it is very harmful and very detrimental in the long run, okay, because of the uh, compounding interest, because simple interest is not applicable over there, compound interest is applicable. So compounding is very detrimental for over a long period of time, because the borrowing is very huge in that case. Okay, so this was about the what do you say, fiscal instruments. Okay, this is regarding the taxation policy of India. Tax policy is supposed to perform multiple functions depending on the needs of the country. And India's taxation policy has been changing from time to time in the process of tax reforms. However, India's taxation policy in general have been designed to perform two basic functions: revenue function and regulatory function. Okay, I have told you the revenue which is being generated by the government, which is being received by the government, is basically through taxation. So taxation plays a very important role in the collection of revenue. And initially, when if I go back again, before 1991, the tax which was imposed on the corporate or on the high net worth individuals, on the rich people, was very high. And so because of that, many of the rich people in the corporate houses were reluctant to invest in India and keep money in India, because they have to pay too much taxes to the government. And so because of that, the growth of the economy was getting roadblocks because of this high taxation. So government of India after 1991 started reducing the taxes and helping the corporate houses, helping the companies and the rich people to invest more in India and to keep money in India, because when money goes out of the country, the economy suffers. When whatever the money is there with the Indians, and it is being circulated in the country itself, then the government need not worry much about the economic development, because that will create the market, that will create the employment, and many economic policies can be made according to that. So taxation is no doubt a revenue function. Okay, because if I want to say, in 1973-74, the marginal tax rate, personal income tax, was 5 lakh for 89%, and incomes over for example, in 1973-74, marginal tax rate of personal income tax on income of 5 lakhs was 89%, and over incomes of 10 lakhs, the tax rate was 95%. Okay, so that was the tax rate at that time. So if that is the tax rate, then people will not, what do you say, not very happy about it, first of all, and they'll not keep money in India, they'll invest somewhere outside. And corporate tax rate, which was 35% in 1957, just after independence, 1 year after independence, it got increased to 45% in 1966, and then to 55% in 1978-79. So that was the increase in the corporate tax rate. So as of now, if we see, the corporate tax rate is somewhere around 35 to 40%. Okay, so not that much. 35 to 40% is the tax rate. It has been reduced. So all these tax rates, and there are different tax brackets in which people pay the income taxes. So all these things, money which is being collected by the government, forms the treasury of the government, fills the treasury of the government. It forms the revenue for the government. And so a tax is a revenue function, but along with a revenue function, it also plays a regulatory function, because government can tax, reduce the rich and poor divide by taxation itself. And this regulatory function include the reducing disparities in income and wealth distribution. Okay, so that we'll tax the rich more and tax the middle class less, and there will be no tax for the poor or for the people who are coming below the income tax bracket, so that the rich and poor divide is slightly reduced. And second is restraining consumer demand with a view to containing inflation. Okay, and if the inflation is going high, okay, if the economy is doing good, there are people working and there are many products are being produced, the people are spending a lot, so in that case there will be an inflation in the economy, because if the people are spending a lot, that means there is a huge demand for products and there will be a shortage of supply. So because of that, the prices of goods will increase and there will be inflation. So inflation is never good for the economy. Slight inflation is okay for the economy, but prolonged inflation is detrimental for the economy. So to avoid the economy or the inflation to go up, government increases the taxes and try to reduce the demand for few products and reduce the inflation as well. So if and also if there is a deflation or a reduction in the price of the products, that is also not good for the economy. Okay, as a consumer you will be very happy if the price of products is going down, but in the long run, or not so in the long run, in the medium run, it is very detrimental, because company will stop producing those items if the company is not getting profit, good amount of profit from that. So if company stops production, then there will be again unemployment, and eventually the supply starts dropping and it will lead to inflation. But the loss of jobs and many other economic shocks the country will face. So the government doesn't want inflation too high or deflation. So it regulates the taxation policy in such a way that the economy is of increasing, but at a constant rate. Okay, there is no much fluctuations. Then third is promoting savings and investments. Okay, the government uses the taxation policy, or there are certain products. If you invest in some mutual funds, for example, or invest in something, then there will be you will be out of you will get some of the tax benefits. If you take if there is a corporate house and the corporate house has taken loan, then that interest amount is being reduced from the taxes, as you calculate EBIT, okay, earnings before interest and taxes. Then you calculate, then you write down the interest, and then you reduce the interest, and then you calculate EBT, okay, earnings before taxes. So the earnings before taxes, on that taxes is applied, so the interest amount has been reduced. So if you take loan, then you will get a benefit for taxes. So in all these type of activities, the government promotes the investment activity and the savings. Okay. Next is shifting investment from shifting investment from non-essential to non-priority sector to priority sectors. Okay, so there are some sectors in which the government wants people to invest. So in those sectors, government can reduce the taxes, so that the people will find it investment in these sectors more attractive. So in pursuance of these goals, progressive tax rates are imposed, excise duties, and and some tax holidays are also given. The regulatory function and the revenue function, both the functions are very much two sides of a coin, or very much related. So if the government is forming a taxation policy, they need to take care of these both functions, regulatory as well as the revenue functions.